Hey everyone, welcome back to the Investing Iguana channel, your go-to source for all things investment related. I'm your host, Iggy, and I'm thrilled to have you join us for another exciting episode. Today, we're delving deep into a subject that's not only incredibly pertinent for our audience in Singapore, but is also universally applicable for anyone contemplating their golden years. We're going to unpack the strategies and insights behind 10 ways Henry built a dividend portfolio for stress-free retirement in Singapore. This episode is a must-watch if you're looking to create a robust financial future for yourself. So, whether you're a seasoned investor or a beginner just starting your journey, grab your notepads, your favorite pen, and perhaps even a cup of coffee, because we're about to dive into some invaluable tips and tricks that could potentially transform your approach to retirement planning. Let's get into it and start building that stress-free, financially secure future you've always dreamed of. First off, let's talk about why dividends are such a big deal. Dividends are basically a portion of a company's earnings that they share with you, the investor. It's like getting a paycheck just for owning a stock. And the best part? Some stocks offer dividends that grow over time. Henry sat back in his plush leather chair, swirling a glass of aged scotch as he pondered the financial landscape before him. Ah, dividends, the unsung heroes of long-term investment, he mused. He remembered the first time he discovered the magic of dividends, likening it to a revelation. To him, dividends were not just a portion of a company's earnings shared with investors, they were a testament to a company's stability and a reward for the investor's faith. It was as if the company was saying, "Thank you for believing in us. Here's your share of the pie." Henry couldn't help but smile at the thought of receiving a paycheck simply for owning a piece of a thriving business. It was like being a silent partner in a myriad of ventures, reaping the benefits without the day-to-day hassles of management. The growth potential of these dividends. Henry vividly recalled investing in a stock with a modest dividend yield of 3.5% a few years back. Fast forward to today, and that yield had blossomed to an impressive 5%, exceeding even his optimistic projections. The idea that this yield could continue to grow was exhilarating. It was akin to planting a seed and watching it grow into a robust tree, its branches laden with fruit year after year. This, Henry knew, was the cornerstone of a stress-free retirement, a financial cushion that not only existed but thrived and expanded. He raised his glass in a silent toast to the power of dividend growth, knowing that it was more than just a strategy, it was a pathway to financial freedom and a cornerstone for a life unburdened by monetary concerns. Henry woke up with the first rays of dawn, a habit he had cultivated over the years, knowing that the early bird catches the worm. As he sipped his morning coffee, he pondered on the importance of starting early in life, especially when it came to financial planning and retirement. The earlier you start, the more time you have for those dividends to grow, he mused, recalling the wisdom his grandfather had imparted to him. It wasn't just a saying, it was a philosophy Henry lived by. He likened it to planting a seed in fertile soil, nurturing it with care, and watching it evolve into a robust tree that not only provided shade but also bore fruit year after year. The fruits, in Henry's mind, were the dividends and interest that would accumulate over time, creating a safety net for his future. And so, as he went about his day, he couldn't help but share this wisdom with the younger folks he encountered, those in their 20s and 30s. Don't be fooled into thinking retirement is a distant dream, too far off to start planning for, he would say, his eyes twinkling with the wisdom of someone who had walked the path. The time to act is now, not later. The tree of your future well-being is waiting for its seed to be planted. Henry knew that the choices made today would echo into the years to come, shaping not just his future, but also the future of those willing to heed his advice. Henry was a man who understood the value of caution and prudence, especially when it came to securing his financial future. Instead of succumbing to the allure of quick riches or high-risk ventures, he meticulously crafted a diversified portfolio that spread his investments across multiple sectors. He chose finance, utilities, and consumer staples as the cornerstones of his financial strategy. These sectors, renowned for their resilience and stability, were not just random picks, they were carefully selected based on their track record of delivering consistent dividend payouts. Henry knew that these were the kinds of investments that could weather economic storms and still provide a steady income, making them ideal for anyone looking to build a retirement nest egg. He spent countless hours researching, analyzing market trends, and even consulting with financial advisors to ensure that his choices were sound. By doing so, Henry wasn't just avoiding the mistake of putting all his eggs in one basket, he was building a fortress of financial security that would serve him well in his golden years. His approach was a blend of wisdom and calculated risk, a formula that he believed would not only protect his capital but also provide him with a comfortable and worry-free retirement. In the heart of the bustling financial district, Henry sat hunched over his dual monitors, meticulously analyzing data streams. Today, he was zeroing in on a specific group of stocks that had piqued his interest, those belonging to the elite circle of Dividend Aristocrats. These were the titans of industry, companies like McDonald's, Walmart, and ExxonMobil that had not only stood the test of time but had also consistently raised their dividends for a quarter of a century or more. For Henry, this was more than just a statistic, it was a hallmark of stability and a predictor of future performance. He knew that these companies were not just flashes in the pan, they were well-oiled machines, with robust business models and resilient market strategies. They had weathered economic downturns, navigated through market volatility, and still managed to reward their shareholders year after year. In a world filled with uncertainty, these dividend aristocrats were the closest thing to a sure bet for long-term dividend growth. Henry believed that investing in these companies was akin to planting seeds in fertile soil, ensuring a harvest of financial gains for years to come. As he cross-referenced balance sheets, earnings reports, and dividend histories, he felt a sense of confidence wash over him. These were the companies that would serve as the bedrock of his investment portfolio, providing not just capital appreciation but also a steady stream of income, thereby securing his financial future and that of his clients. With a few clicks, Henry executed a series of trades, strategically allocating funds to these dividend-growing giants, fully aware that he was investing in companies that had a proven track record of not just surviving but thriving. In a brilliant stroke of financial acumen, Henry decided not just to diversify his portfolio, but to strategically incorporate stocks that paid dividends on a monthly basis, such as specialized real estate investment trusts, REITs. He recognized the value of having a consistent cash flow, especially when one's livelihood is primarily dependent on investment income. By doing so, Henry ingeniously made budgeting a far less daunting task, allowing him to plan his monthly expenses with greater precision and peace of mind. This move was not just about immediate gains, it was a long-term strategy aimed at creating a more stable and predictable financial future. He meticulously researched various REITs, focusing on those with a solid track record of performance and reliability. After all, the goal was not just to receive dividends, but to invest in assets that had the potential for capital appreciation as well. Henry understood that in the world of investments, it's not just about what you earn now, but what you stand to gain in the long run. His decision to include monthly dividend-paying stocks in his portfolio was a testament to his foresight and a masterstroke in financial planning, one that would serve him well in the years to come. Henry sat at his sleek, mahogany desk, surrounded by multiple monitors displaying real-time stock market data and financial spreadsheets. As he sipped his freshly brewed coffee, his eyes narrowed on one particular metric that often went overlooked by novice investors, the dividend payout ratio. For Henry, this wasn't just a number, it was a crystal ball that offered a glimpse into a company's future. A lower ratio, he knew, signaled that the company had ample retained earnings, thereby providing a cushion for potential economic downturns and the flexibility to reinvest in growth opportunities. It was like a safety net, ensuring that the company could not only sustain its current dividend payments but also had the potential to increase them in the coming years. This made it an ideal choice for long-term investment, a cornerstone in the fortress of his diversified portfolio. He leaned back in his chair, contemplating the ratio's implications. It was more than just a figure, it was a strategic tool that could help him make informed decisions, mitigating risks while maximizing returns. With a confident smile, Henry clicked the mouse, adding shares of the company with the promising dividend payout ratio to his investment basket. He knew he was not just betting on a company, he was investing in a future that looked a little more secure, a little more prosperous. Now, let's delve deeper into the complex world of taxes, a subject that Henry had always found intriguing, especially in the context of Singapore. In the bustling financial hub that is Singapore, dividends are generally tax-free, a fact that Henry considered a monumental advantage in his investment strategy. He sat at his sleek, glass-top desk, poring over financial reports and spreadsheets, his eyes scanning rows of numbers and percentages. He knew that even in countries where dividends are subject to taxation, there exists a category known as qualified dividends, which are often taxed at a significantly lower rate compared to ordinary income. This was a nuance that Henry couldn't afford to overlook. With this in mind, he meticulously sifted through a myriad of stock options, his fingers dancing over the keyboard as he filtered and sorted data. He was on a quest, a mission to focus exclusively on stocks that offer these qualified dividends. He understood that this approach could potentially save him a substantial amount in taxes over the long term, thereby maximizing his overall returns. Henry felt a sense of satisfaction wash over him as he finalized his selections, confident that he had made yet another savvy financial move in the intricate chess game that is investment planning. Henry, always the savvy investor, had a particular fondness for dividend reinvestment plans, commonly known as DRIPs. He saw them as a financial tool that could amplify his earnings in a way that was both automated and efficient. Instead of merely collecting the dividends from his investments, he opted to have those dividends automatically reinvested to purchase additional shares of the stock. This decision was far from trivial. It was a calculated move that Henry likened to setting a snowball rolling down a hill. As the snowball gained momentum, it would collect more snow, growing larger and faster with each revolution. Similarly, the reinvested dividends would buy more shares, which in turn would earn even more dividends. Over time, this compounding effect would significantly boost his income, turning what was once a small stream of dividends into a roaring river of financial gains. Henry knew that the beauty of DRIPs lay in their ability to capitalize on the power of compound interest, allowing him to exponentially increase his wealth without lifting a finger. It was a strategy that required patience and a long-term vision, but Henry was more than willing to play the long game, confident that his decision to engage with DRIPs would pay off handsomely in the years to come. Henry sat at his sleek, mahogany desk, meticulously scanning through the stock market listings on his dual monitors. His eyes narrowed as he spotted stocks offering unreasonably high yields. For a fleeting moment, the allure of quick, substantial returns tugged at him, but his years of experience in the financial world held him back. He leaned back in his ergonomic chair, contemplating the hidden dangers that often lurk behind such enticing offers. High yields usually mean high risks, he muttered to himself, recalling the countless times he had seen investors lured into the trap of unsustainable payouts, only to face financial ruin when the stocks inevitably plummeted. With a resolute shake of his head, Henry steered clear of these volatile options. Instead, he focused his attention on more stable, long-term investments that promised consistent, albeit smaller, returns. He knew that in the marathon of financial planning, it was the steady pace that won the race, not the reckless sprint toward immediate gratification. By avoiding the siren call of high-yield stocks, Henry was not just preserving his own financial security, but also setting a prudent example for his clients, who looked to him for sage advice on risk management and sustainable investing. Henry was far from complacent when it came to securing his financial future. He understood that a well-managed portfolio was like a carefully tended garden; it needed regular attention to flourish. So, every month, he would meticulously go through his investment statements, armed with a cup of black coffee and a calculator. He wasn't just content with setting it and forgetting it. That approach was far too passive for someone as proactive as him. Instead, he analyzed the performance of each asset, comparing it against market trends and his own retirement objectives. If he noticed that a particular stock was underperforming or that his asset allocation had drifted from his original strategy, he took immediate action. He'd rebalance his portfolio, sometimes shifting funds from equities to bonds or vice versa, always with an eye on risk management and long-term gains. He'd also consult with his financial advisor to ensure that his moves were sound, not just reactive. Henry knew that the path to a comfortable retirement was not a set-it-and-forget-it journey, but a dynamic process requiring ongoing adjustments. By doing so, he wasn't just preserving his wealth, he was actively growing it, ensuring that when the time came to hang up his boots, he'd have a financial cushion substantial enough to enjoy the golden years he'd worked so hard for. Absolutely, folks, you've just been presented with a comprehensive guide featuring 10 distinct strategies that Henry employed to construct a robust dividend portfolio, all aimed at ensuring a tranquil and financially secure retirement in Singapore. These foundational principles are not just limited to those residing in Singapore, they are universally applicable and can assist you in achieving a similar level of financial freedom, regardless of your geographical location. If you found the insights in this video to be valuable and enlightening, we strongly encourage you not just to hit the like button, but to also make sure you're subscribed to our channel. This way, you'll continue to receive a wealth of investing wisdom and strategies directly to your feed. So, until we meet again in our next video, this is Iggy, the Investing Iguana, bidding you farewell. Continue on your journey of smart investing and consistent financial growth.